Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. By now you've probably heard of the SVB collapse, the Silicon Valley Bank that last week announced liquidity issues, of course creating a panic amongst investors that had deposits at the bank. But this is not just SVB. We're seeing signs of contagion in other parts of the banking sector. In the ETF KRE, the regional banking ETF, is showing signs of collapsing as well. The ETF dropped down a staggering 16% on Friday last week. Remember, this is an ETF that has a market cap of $1.6 billion. So absolutely massive wealth destruction happening right now. In this video, I want to talk about why recessions now are accompanied by banking crises. This is the first time we're seeing signs of a collapsing financial system since 2008. So I want to put that in historical context in this video. And I also want to talk about the fact that the collapse has extremely high risks of contagion in other areas of the financial system, why the market panic that we're seeing right now is justified, and how that could actually impact the S&P 500. If you enjoy this video, don't forget to smash the like button, share it on social media. Now, without further ado, let's get right into it. Now, this is the first chart that I want to show you guys to basically explain the point. Why does it seem like we have more banking crises than we did throughout recent financial history? And this is a chart that comes from a research paper showing data going back to the early 1900s. It shows the leverage ratio of the US banking sector over time, showing you the elevated ratio leading up to the Great Depression, the deleveraging that happened in the 1930s and during the World War period, and then the re-leveraging that we saw leading up to 2008. The leverage ratio of US banks is the institution's exposure to risk. It's not a surprise that we had a banking crisis in 2008, and it shouldn't be a big surprise that we have a banking crisis today in 2023. Now, this is something that we've been talking about for a while. The yield curve has been anticipating a hard landing, a recession, a mistake from the Federal Reserve. Every time you have a yield curve inversion, you end up having a hard landing, a real recession. Not a soft landing, a hard landing. As short-term yields go higher than longer-term yields, that is the bond market telling you that monetary policy, the Federal Reserve, is hiking rates too quickly. Something we've been talking about for quite some time. The hiking cycle we had throughout the last year has been historically aggressive, unprecedented in terms of the rate of change of the tightening of financial conditions we've seen. So you combine that with a leveraged banking sector, and that's how you get these types of black swan events. When these banks like SVB start to face liquidity issues because of the tighter monetary conditions, you start to get money that flows out of that bank. And that's what you call a bank run, and is exactly what has been happening with SVB. Total deposits collapsing here as investors panic on the possibility of failure of this bank. Now, that's a vicious cycle because the fact that these deposits are going down increases the odds that this bank will fail. And of course, it will fail if enough people ask for their money back. That's the entire concept around fractional reserve banking. When you give $1,000 of deposit to a bank, legally, it can keep just $100 in the bank and loan out 90% of your money to somebody else. The entire banking system works like this. If everybody one day wakes up and asks for their money back, you get a banking collapse. And that's exactly what is happening right now with SVB. It's what's happening with Signature Bank, SBNY, that's also been collapsing here. And it's exactly what's happening with FRC, the First Republic Bank, also collapsing, pre-market collapsing. Comerica Incorporated, CMA, it broke down below a massive head and shoulder pattern right here. Neckline here. The measured target takes this stock to around these levels here. So another 30-40% drop from current levels. So the market has been anticipating this for quite some time. The market knew in August of 2022 the countdown had begun before we started to see black swan events like this. Now, all of these banks that I just cited have something in common. They are regional banks. You look at the ETF KRE, the regional banking ETF. That's the ETF that is collapsing. That is the ETF that is moving down the quickest. You look at XLF, the financial sector of the S&P 500. Yes, it has been moving down, but nowhere as quickly. In fact, you take a look at KRE divided by XLF, and you're seeing a massive drop in KRE's market cap relative to the financial sector. So what's happening here is investors are seeing these regional banks as higher risk than these massive too big to fail banks like Bank of America, JP Morgan. And so you're seeing a bank run on the regional banking sector as these investors are pulling their money out and moving to other banks. Again, you look at the ETF KRE, and it's telling you right now from a pure tea leaves technical analysis standpoint, head and shoulder topping pattern that broke down last week here. You take a look at the measured target on that pattern, that's around a 28% drop that could take us hypothetically all the way down here. So telling you that this has not been completely priced in. This could go down a lot further. And the only way this can stop is if the Fed steps in aggressively enough and stop this panicked investor psychology where investors are pulling their money out of these banks in a typical bank run. And the Fed does have the power to do that. Right? The Fed had the power to do that in 2020. Right here, you had a panic in the financial system here in March of 2020. The Fed had to step in with massive amounts of money, massive amounts of stimulus to bail the economy out. Of course, the decision back then was a lot easier because you had inflation at pretty much 0%. The risk of deflation rising substantially back here. Right now, you're at 6.4% inflation. The Fed has been extremely determined to bring inflation down to 2%. So are they going to step in with the same force that they did back here in 2020? The odds of that happening are extremely low. So it's hard to see exactly what's going to end up happening. I do think the charts suggest that this is not over, that this has not been completely priced in. And if we have the regional banking sector that completely collapses, that is a problem for the economy. Don't think it's all about XLF. KRE is important. Regional banks are the banks that finance local projects, local startups, local restaurants. A huge number of small businesses are financed through the regional banking sector. So if the Fed doesn't step in with enough force, this could create a much bigger problem down the road. Remember in 2008, the failures that we had in the regional banking sector anticipated the rising unemployment. It anticipated the recession. Perhaps this breakdown that we're seeing is the very beginning of that phenomenon that starts to get priced in by the financial markets. The S&P 500 on Friday failed to stay above broken downtrend line right here. Now, of course, that can always reverse, especially if you have a big speech from the Fed that reverses monetary policy. But from a technical standpoint, you have this breakout of this downtrend line. And now we failed to stay above it. S&P 500 breaks back below this downtrend line. That's a false breakout, something we made a video out of. We made a thread out of on Twitter calling this S&P 500 breakout a bear market rally, that this essentially has happened in every single major bear market since 1960. And meanwhile, you've got the Treasury bond ETF TLT that's rising exponentially here with a lot of green volume here, a lot of conviction behind this move as investors are seeking protection against a recession, something we've been positioned for over the past few months. We've been increasing significantly our allocation to TLT. We started to significantly increase our allocation to cash and other defensive positions. We're very happy with that decision. And again, it's not rocket science. It's not about having to know the financial statements of these regional banks in order to predict this type of price action. We had the signals from the bond market. We had the signals from leading economic indicators that were telling us to get defensive. If you want to stay up to date on our model portfolio, make sure to get yourself a free trial at gameoftrades.net. Now, I hope you guys enjoyed this episode. If you did, don't forget to smash the like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.